All right. This is a good one, guys. It's a controversial subject. It talks about paying off your mortgage early and that being one of the best ways to save huge money. We've mathematically quantified that for you many times on this channel. And for many people, it can save and will save tens to even hundreds of thousands of dollars off the price tag of your home. It's a guaranteed way of doing it. So you might be tempted to make early payments on a mortgage or implement one of the mortgage acceleration strategies that we talk about here on the channel, especially if you have the cash flow available to you. You could be able to retire debt-free, very appealing idea. You can save a ton of interest, you can even redirect the savings and that increased cash flow into higher earning investments too. But there are downsides to consider, and paying down a mortgage early is not a good move for everybody, especially right now. And we've talked often and at great length about various strategies to pay down your mortgage quickly. Everything from the bi-monthly mortgage payment to mortgage acceleration or velocity banking. And you can do this in as little as 5 to 10 years. And that's a strategy that we've recommended heavily to those people that could afford to implement it and also diversify their wealth creation and put money into other wealth creation strategies too. Now, when one is trying to boost their cash flow, taking care of tens to even hundreds of thousands of dollars in future interest costs is often a no-brainer. Sometimes this was even true for people who had record low interest rates, these historical low interest rates that we enjoyed for so long. Mortgage companies were set up to make hundreds of thousands of dollars off of homeowners who would pay their mortgage over the entire term of that 3-decade mortgage. And this is because interest rate is not the only thing to consider when it comes to debt and your debt reduction. The term is the other half of that equation. And that's how long the loan is scheduled to be paid back. And that's equally, and in some cases even more important to take into consideration. The longer the term, the more that interest is going to accumulate on that debt. For example, if you had to simply pay 3% interest on $500,000, you'd be paying $15,000 in total interest. But 3% interest on a mortgage works out to $258,880. As you can see, the amortization schedule, or the length of time it takes to pay the loan, heavily affects the total interest costs that you'll pay. You'll pay a very front-loaded interest cost over that term, and your principal actually goes up over that same term. So it's critical to understand both sides of an amortization schedule. Obviously, the interest rate remains incredibly important, of course, but the term as much so. So those who could afford a $400,000 house just 9 months ago, when interest rates were around 3%, can really only afford a $250,000 house today with rates at 6%, and that's a huge difference. So those that are carrying mortgages with, say, a 3% interest rate would seem to be sitting in a really good spot relative to those getting into mortgages right now, while the interest rates are at that 5 to 6%. For those getting mortgages right now, it would also seem extremely beneficial, perhaps, to do what they can to avoid exorbitant amounts of interest costs that you'll be obligated to pay over the next 30 years. And as we can see already, there are several things to consider when deciding whether an accelerated mortgage payoff strategy is right for you right now. Let's first look at the pros of paying off a mortgage early. Obviously, one big advantage to paying down debt in general is that it can free up a lot of money. You're not just avoiding the high cost of interest over time, especially with non-mortgage related debts, but you're avoiding the big payments that come with something like a mortgage. You can be saddled with heavy monthly payments, and instead that principal and interest payment can go toward other investments. And in the long run, that could mean a lot of wealth to you. You can free up that money to let you invest in other things and even leverage to do so, and then sort of snowball that principal and interest payment into the next debt. And the benefit here can be huge, really, because you're just spending so much less on interest costs over the long run while optimizing credit scores in a lot of cases, which in turn could afford you the ability to get access to even more resources, or what we call debt weapons, and then put those tools to work in order to purchase new income producing assets or other cash flow producing investments. So by freeing up your monthly mortgage payment amount, by paying a house off, which I've done, I've paid a home to zero, you can simultaneously save tens to hundreds of thousands of dollars in future interest costs, and also put your available cash to work for you where you're generating new income. So, two-pronged benefit with that. So that's really the goal when it comes to a strategy like the one that we've talked about, in our Pay Off Your Mortgage in 5 to 7 Years video, which I'll link in the description. Now, I think one of the other big pros that is a little difficult to quantify as far as the exact value is the peace of mind that comes from having your home or some of your biggest debts paid off. Whether you're talking about a student loan, whether you're talking about an investment property, whether you're talking about your primary residence, having a home that's paid to zero offers tremendous peace of mind. The security that comes with that is, from what I've experienced over the last 20 years of working with people one-on-one, and this is now 22 years, I'm gonna stick with saying 20 because I'm sick of dating myself. It's getting crazy how long I've been doing this. You know, I can't stress enough how often it's far less about the greed factor, why people are pursuing wealth creation and financial independence. It really categorically falls far more into either the security and peace of mind factor or the, listen, this is a freedom of choice reasoning, where people are just really wanting to have that independence to do what they want with their time. Money is just simply the tool that provides you either of those two results. So that would be another area that I would consider to be a huge positive. And another one that Dave Ramsey talks a lot about is that from the psychological benefit standpoint, you're going to come out well ahead by attacking even a low interest mortgage, even if you could take those same dollars and reinvest them elsewhere under a speculated return that exceeds the cost of the interest that you're paying to remain in some form of a mortgage or a loan that you're using to make that specific purchase or investment. So now that we've covered the pros of paying a mortgage early, what I want to do is next discuss a few of the cons of getting rid of debt early. So the cons of getting rid of debt early and saving tens to thousands of dollars in future interest costs may seem like a short and silly list to some. But the truth is that we're in an economic cycle right now where debt payoff may not be the best go-to strategy for a lot of you listening right now. With inflation now over 8%, it would seem that interest rates would cost you less money to keep than it would cost you to pay early, while money is losing value every day. This, of course, is not an accurate way to look at it, as we've already shown the compounding effect the term of your mortgage plays on the overall cost of interest that you'll end up paying. But just for the sake of argument, if inflation were to continue at this rate for the next several, say, decades, then it would certainly not make any fiscal sense to pay your mortgage now if it carried an interest rate of 3%. Now, fortunately, we don't expect inflation to last at this level for the next 30 years or anything remotely close to that. So that being said, the state of things now should play a role in how you approach your financial strategy. As we've stated for months, it is going to be increasingly important for you to remain liquid for the foreseeable future. And with the way the housing market and the economy are looking right now, it's getting more and more likely that a good-sized reset is imminent, meaning deals are on their way, opportunities are coming. So it's crucial to build up your liquid reserves so that you can strike when those are in front of you. If you were to use up your liquid capital on a debt reduction plan right now, then you could lose your ability to pick up discounted properties or other investments in the coming years. It's all about weighing the pros and cons of each and deciding what your risk tolerance is. For many, the risk involved with paying off debt early is next to zero, as it carries a guaranteed return in the money saved in interest costs avoided. And that is true to an extent, of course, as I'd previously mentioned. But it does not take into account the amount of risk involved in placing yourself on the sidelines when there are deals available. So lost opportunity is certainly something to factor in when you're counting your losses. If you lose an opportunity, it's a loss. And there is good money that will be made in the next few years. Just think back to the crash of 2008. How much would you give to go back in time and snag some of the incredible deals that were available to those that weren't sidelined or to those that were actually taking action? And this is something to consider moving forward. Another con to consider is on the tax side of things. This is because homeownership comes with its own set of tax benefits. One of the biggest advantages is the mortgage interest deduction, which lets you write off interest. So when you pay off your mortgage, you give up that valuable deduction, which can add a lot of taxable revenue to your income. But the mortgage interest deduction is available only when you itemize your returns, so the tax benefit really wouldn't be available at all for those who are better off taking standard deduction, the standard deduction rather. Now, potential early prepayment penalties, though they are rare, would be another downside to consider before paying off any debts early. Fees are usually charged only if you're very early and you pay off the loan, say, within 3 to 5 years. 20% per year is not uncommon for mortgages. Not all mortgage lenders charge a penalty for early prepayments. However, so you do want to just sort of read through your paperwork and determine whether or not there is any sort of a prepayment penalty, or you can just simply call your lender and they'll be able to give you that information. With something as complicated, as potentially beneficial as this is, it's important to understand how it will affect you personally based on both your short and your long-term objectives. So this is actually why we created the Cash Flow Cruncher. It's a completely free tool. It enables you to track all of your expenses as well as run your accelerated debt payoff simulation so that you can actually see exactly how much it would benefit you to implement an early mortgage payoff strategy. There's a loan calculator in there that's provided on one of the tabs. Fabulous tool, one of the best I've seen on the market, and like I said, it's totally free, so you can't beat the price. Make sure you get a free copy for yourself. You can do that by visiting the website cashflowcruncher.com or by clicking the link in the description below. I'm curious how many of you guys have implemented an accelerated debt payoff plan in your finances. Are you doing just your non-mortgage related balances? Have you used any of the strategies that we talk about on this channel to pay off your non-mortgage or mortgage related debts early? Make sure you're talking about it in the comments below just to see how the process went for you. Check the comments in the other videos that I linked in the description for you as well, just to see how it's working for other people so that you can get some objective feedback before you decide what you want to do for yourself. We're also going to be going back to offering complimentary coaching sessions. Once again, this is something that we did for almost 11 years until we got literally an entire year waiting list on that, and we had to maintain that for several years straight. So we're going to start doing this in a contest format. Make sure you're a commenter now and subscribe to the channel, because we will start announcing that in weeks to come. And I'm going to be offering that coaching session for you here personally so that we can get you some roadmaps and address some of your biggest questions and concerns related to the topics that we discuss here on this channel. If you wouldn't mind dropping a thumbs up, it takes us a lot of work to put these together, and it also is something that we love doing in order to get you guys further, faster financially. So let's offer each other a trade. Throw that thumbs up for me so that YouTube knows you enjoyed the content and want to continue to get more information from us. And then turn on the bell notifications. And until we see you on the next video, make it a great day, and most importantly, keep on cash flowing. See you soon.